We're going to look at Alaska Airlines. And what we're going to do is go through the process for valuing a company. We're going to enter financial information into the model, and that way we can estimate the future free cash flows of the company. Then figure out a discount rate we need to apply to those cash flows and discount the dollars back to today's values. And then we'll have an intrinsic stock price, and we can compare that to the actual stock price to see if it's a buy or a sell. And then at the end, we're going to look at the financial ratios of the company and compare it to its competitors. So Alaska Airlines is the fifth largest airline in the US. It has 16,000 employees, and it's ranked as having the highest customer service of all the airlines. And it acquired Virgin America for $2.6 billion back in 2016. So let's get started in the model. We need a market cap, which is $5.6 billion. And the stock price is $45.73. And next we need the free cash flows, which is the cash that's left over after running your business. And it's positive every year, which is a good sign. That means it's operating a profitable business. Net income is the profit and loss for a given year. And that's also positive, which helps a lot because when looking at deals, if there's a lot of negatives in the numbers, it makes it really difficult to forecast. So it looks like the free cash flow is kind of all over the place. That can happen with free cash flow, especially if some years you have big investments. Like if they bought a lot of planes in 2018, they could have used a lot of cash that year. Net income is also up and down. And it looks like revenue has increased each year. And that's always a good sign when you invest in a company to see their sales increasing. So everything looks pretty good so far. So let's figure out the capital structure of the company so we know what discount rate we need to use to apply to the cash flows. They pay $63 million in interest on their debt. Let's go to the balance sheet and see how much debt they have. So current debt is $235 million. And non-current debt, long-term debt, is $1.3 billion. So they pay 4.2% interest on the debt. Interest payments are tax deductible. So let's see how much interest taxes they pay. So we get the income before tax and then the income tax. So they pay 24% of taxes. So the cost of the debt is 3.2%. And they don't have too much debt, only 21% of the capital structure. So there's a lot of room to borrow. And we need the beta so we know what the volatility of the stock is, 1.51. That means the stock moves 1.5 times of what the market moves. And the cost of equity is 14%, and the cost of beta is, the cost of debt is 3.2%. So equity is usually more expensive than debt because in the event of a default, equity holders get paid after debt holders. So when you combine the cost of equity and the cost of debt, you get 11.65%, and that's the weighted average cost of capital, and that's what we're going to use to apply to the future cash flows. So we estimated 4 years of future free cash flows based off of the inputs from earlier, and then we did a terminal value. We used the Gordon growth model for that, and that's all years past year 4. We discounted those numbers back to today, and we get a value of the company of $7.2 billion. When we divide that by 122 million shares, we get a stock price of $59, and it's trading at 46, so it's trading at a 22% discount, so it's considered a buy according to the model. So that's a good sign. It looks like the stock was trading in the 60s and 70s for a while. It even peaked around high 90s, low 100s. So it's come down a lot, so it's come down below intrinsic, so it's now trading at a discount, which is good for an investor. but you may not feel the future of the company is worth $59. The market is saying it's worth $46. So it's for you to decide if you think the airline business is going to be strong in the next year or two, if sales will pick up during coronavirus. And the stock market is not based on what a company's worth. It's really based on the supply and demand of the market. When more people want to buy a stock, the price goes up, and when more people want to sell the stock, a price goes down until equilibrium is found and they both agree on a price. And there's a lot of indicators to figure out the stock price. Earnings and fundamentals is what we went over, and that's a good indicator. And sometimes that doesn't always work in the short run, and a market sentiment, how people feel about an industry, may affect the stock price. So it could take a long time, it could take years for the stock price to reach its intrinsic value, what it's really worth, if at all. And there's other factors also involved, like technical factors, the historical price of the stock, inflation, taxes, competition. So there's a lot of stuff that goes into the valuation. And the only way to really mitigate these types of things is to hold the stock long term and ride out the ups and downs. Because if you pick a stock with good fundamentals, you should win in the long run. Let's look at the financial ratios. So we need a little more information from the balance sheet. So we need the current assets, which is the cash, accounts receivable, inventory. And that's pretty much assets that you can easily convert to cash. Current liabilities is the debt that's due within 12 months. And the equity is the value of the company. And now let's get their earnings before interest and taxes, the EBIT or operating income. That's 1.1 billion. So they have a really good PE. It's under 15. I like to see under 15, 7.3. That's net income over shares per earnings per share. And earnings per share is net income over shares outstanding. And companies can improve their PE if they buy back stock, because that lowers the shares outstanding. And they could also improve the PE by taking on lots of debt, because usually debt doesn't affect your earnings, and you can use the debt to maybe buy more planes to bring in more revenue. The price of sales is a good indicator if a company has a really difficult PE to the value. They have a good PE, but some companies like startups or newer companies or companies growing have PEs like 30, 40, 100. So they're not really good reads of the company. Next is current ratio, which is the current assets over current liabilities. And this is an indicator of your short-term liquidity. And if you have under 1, that is not a good sign. That means you don't have enough liquidity to run your day-to-day operations. And this is pretty common with airlines, it seems. They have current ratios under 1. So that just means they have to get into more debt in order to run their business. And hopefully this is just a short-term problem. And in the long term, they'll have a current ratio above 1. But that remains to be seen. They have a decent ROA. I like to see above 20%. 18% is not terrible. But we'll compare it to the other airlines to just see these ratios, how they stack up. Interest coverage ratio is a good indicator if a company will go into default. And they have a good interest coverage ratio. That's the amount of earnings they could bring in divided by the interest expense. So how easily they can afford to cover their interest. And the interest is what we input earlier, the 63 million, the interest on their debt. And they could cover it almost 18 times. So they're not in a situation where they would be in default anytime soon. And if you compare it to other airlines, Alaska is right here, and I compared each ratio. So Delta has the best PE, they have the lowest, but they all have good PE ratios. American has the best price to sales ratio, but they all have pretty good price to sales ratios, all under 2.2. Price to book, JetBlue has the best price to book, but they're all pretty good except for American Airlines, which has negative book value. Current ratio, Spirit is the only company that has a current ratio above 1. So the rest are operating at a disadvantage. But that will probably pass after coronavirus. They'll probably become more stable and profitable again. But at least for the short term, you may see these companies taking on more debt or posting more losses. The ROE, Delta has the best ROE. Alaska is 18%. So all the airlines aren't too strong in this category. They're okay. But if you wanted to invest in a company with similar risk, you might be able to find that pretty easily that offers a better ROE. And the debt, American is really in bad shape with debt. Southwest is in the best shape. They only have 11%. And this is important, especially during a pandemic like coronavirus, because you may need to take on more debt to operate your business. And even if you have a really profitable business, if you're all maxed out on debt, you might have to file bankruptcy because you need to borrow just to fund your business, especially when sales are low. So let me know what you think in the comments. Thanks for watching.